Welcome to the third annual Barclays Crypto and Blockchain Summit. We have a great roster of speakers lined up over the next couple of days who will shed some light on where the industry stands following a admittedly tough 12 months for the sector. So much has changed since our conference last year, with quite a bit of speculative excess having left crypto, I think, at this point. But what I see is an industry where, despite the turmoil, innovation has not really slowed down. If anything, a focus on utility, infrastructure, viable use cases has kind of emerged and bubbled up. We're still believers in the underlying blockchain technology, continue to see it as transformative over a long period of time. So our hope over the next couple of days is to focus on the pragmatic side of the industry, on projects that have the highest probability over time to play an important role in fulfilling the potential of the technology when it comes to actually changing the way we do things. And there is no more fitting speaker with which to open our conference this morning than Sergey Nazarov, co-founder of Chainlink, which is the most widely adopted Web3 services platform, facilitating trillions of dollars in transaction volume across key blockchain sectors such as DeFi, insurance, gaming, NFTs, and other major verticals. It's been a volatile time in the financial markets over the past few weeks. I'm excited to explore how blockchain technology may have a role in improving the systems and architecture underpinning our financial markets. Sergey, thank you so much for being here. Really appreciate it.
It's my pleasure. Thank you for having me.
Great. Let's jump right in here. First question for you, Sergey. In the wake of all of the turmoil in the financial markets, the recent bank failures, what are you seeing in terms of financial institutions exploring blockchain-based solutions to regain user trust? How do you see capital markets benefiting from blockchains and smart contracts?
So I think there's three ways that capital markets folks traditionally view smart contracts and blockchains. One way, the way that usually moves the slowest is the efficiency mode, where they kind of say, what efficiencies does this create? You often hear questions about creating a golden record and the value of a golden record and reconciliation across counterparties becoming faster, more efficient, that type of thing. This is the slowest mode of blockchain adoption, which doesn't have a ton of urgency to it because it's basically a cost and efficiency gain. Then you see the second mode, which takes the form of custody, most recently, where basically their clients come to them and their clients say, I would like to make money by custodying cryptocurrency. I want to own cryptocurrency. I'm your client. Please help me do this. And so this whole custody question comes into being, and banks and various traditional financial markets custodians start implementing crypto custody solutions. And then the next stage of that is once that custody is enabled for their banking clients and their custody clients, the next question will be, what can I do with the assets that I custody with you? Can I get a rate of return on them? Can I put them into this DeFi pool, that DeFi pool? Basically, how do I get a return after I've gotten custody? And the whole custody thing, I think, is for different reasons for different institutional clients. Some of it is speculative in the short term. Some of it is a long-term focus on maybe Bitcoin or other coins. Some of it is just within the scope of basic diversification that's becoming a more common idea. And this is one of the ideas that I think will gradually over time take a percentage of institutional capital and move it into the blockchain industry, just as diversification thesis, in that you should be in multiple areas to some degree. So those are the two more traditional ones. The one that we're seeing now with recent bank failures gives rise to a third one, which I call the fast case for blockchain adoption. So the previous two are the slow case, and the one that's happening more now is the fast case. And that's the one where there's a fundamental crisis of faith in a brand. So there's banks that have existed for many years, like Credit Suisse, for example, I think was started in the late 1800s, something like 1870, 1876. And that institution, while it was in the most reliable jurisdiction for banking historically, doesn't exist anymore, which is unfortunate. But in addition to being unfortunate, it starts to create this psychological crisis of faith for both retail and institutional clients. And so this is the thing that blockchain technology fundamentally solves is it's a technology that can resolve this crisis of faith by guaranteeing counterparty relationships. And when I say guaranteeing, I don't mean guaranteeing in the sense that there's a brand and the brand hasn't existed for over 100 years. And you can trust me, I'm regulated, or I'm really old as a brand, or I have tens of billions of dollars as a brand. Like if brands that have tens of billions of dollars are regulated and 100 plus years old don't continue to exist, then being a brand of that kind doesn't have the same value anymore. Similarly, the analogy I think about that's kind of most relatable to the most people is text messages. So 10, 15 years ago, everyone would send text messages to each other unencrypted over SMS, right, over telecom networks, or they would use applications that were unencrypted in social networks or whatever. And then a crisis of faith appeared where people no longer trusted telecommunications companies because they were getting hacked, and they no longer trusted social media platforms to hold their unencrypted messages. And this is why at the top of widely used billion-plus user applications like WhatsApp, you have at the top of each message session the term end-to-end encrypted. Because what happened was you had these brands, these entities, which promised a certain user relationship. And because they didn't deliver on that user relationship, what happened next was there was a crisis of faith, and then faith was restored through technology, specifically encryption technology, specifically end-to-end message encryption for text messages. And I think that the first two examples that I talked about is the way that banking has traditionally looked at blockchains. It's what is the efficiency gain and how do I make money from people that want to deal with this cryptocurrency market? Once again, that's the slow case. The fast case is if there's a crisis of faith, and then the question is, how do you restore faith? And my view, my very strong view, is that you restore faith through encryption technologies, which is what blockchains and oracles and smart contracts are. They're basically encryption technologies that apply very directly to the types of transactions and to the types of relationships that banks have with their clients and that clients have with each other through these institutions. And I think it's actually a net benefit to those institutions because it'll make them better. It'll make the whole global financial system better. It'll make smaller local emerging market financial systems better. It's actually a big boon to globalization because you don't need to trust people's local legal systems to transact or do foreign direct investment because the local legal system doesn't matter anymore. The only thing that matters is that you have cryptographically guaranteed relationships, which is once again what all this does. So I think what I'm starting to see with this small spike in traditional financial system issues is a very small window into what the fast case begins to look like. And my view is that the fast case, due to various monetary policy decisions and other very disconnected from reality decisions, that the fast case will unfortunately inevitably happen. It's just a matter of when will it happen, and most commonly this is expressed in both some kind of timeline and the concept of soft landing versus hard landing. So basically, in that terminology, I think there's going to be a very, very hard landing, but I don't know when, because there's just so many variables in that equation.
That is a great segue to my next question, which was about tokenization. It's been gaining rapid interest across financial institutions dealing with traditional assets such as bonds and commodities. Level set for us a little bit. What is tokenization in this context, and how can institutions, securely bring those tokenized assets onto blockchains?
Sure. So tokenization obviously began with Bitcoin, the first cryptocurrency, which was the only thing that existed 10 plus years ago that I got into this industry. And so tokenization for me has always been cryptographically guaranteed ownership. So the reason that tokenization is attractive for me is that you have user-controlled ownership. You have private key-controlled ownership. It's not ownership that depends on a counterparty deciding whether to give you your assets. It's ownership that has to do with your ability individually to control your assets, irrespective of anyone else's decisions. And bank failures, which are the common counterparties for people to hold assets into, or put assets into and hold them there, people losing faith in those containers makes direct control of assets more attractive. Now, I don't think that's why it's attractive to the capital markets industry, but I think that's the fundamental idea that gave rise to Bitcoin. And then on top of that, you had censorship-resistant currency, and then you had store of value, right? So you had user control, censorship resistance, and store of value. And the store of value thing is what the capital markets focus on much more, while not focusing as much on the user control and the censorship resistance. So I think that tokenization for the capital markets has begun with various client interest in cryptocurrencies, because that's the first thing that tokenization did, was it created these kind of artificial tokens, these things that didn't exist before. And basically banking clients came and said, I would like to gain access to tokenization, or in banking terminology, digital assets, right? I would like some digital assets, please. I would like some Bitcoin. I would like some other digital asset. And so that began this question of custody, that banks are now tokenizing bonds, commodities, sometimes through equities and various other things. I think what that speaks to is two things. Firstly, it speaks to a general increase in demand for digital assets as a class, as an asset class. Now, it's not completely clear to me what digital assets as an asset class means when you take traditional assets and you put it in there, because I have to look at how that digital asset is built and whether it actually gives you any user control, or whether it actually gives you any additional benefits about your ability to access it quicker and therefore reduce your counterparty risk, maybe transfer it quicker, move it around quicker, get more information about the asset because it's a digital asset. For example, digital assets can have various key pieces of information added to them so that the asset consistently becomes updated about what's going on with it. So I think that the thing that's happening is, A, digital assets are becoming more of an asset class. B, I think there's efficiencies to be gained from tokenizing existing traditional things in the financial system. And C, I think there's actually a dimension of cryptographic truth guarantees, which is that third case, right? So if I have digital assets that I can transfer to you very quickly and that you can control and that are beyond certain dimensions of risk, then maybe a digital asset formatted piece of value is more attractive to you as a counterparty than a traditional piece of value, right? Now, I don't think that most banks are thinking about it this way, but I think there is this third dimension. And this third dimension sounds crazy, right? And I've been saying this third dimension of this industry for about maybe 4 or 5 years, speaking about it pretty regularly. And it sounds pretty crazy, right? Because everyone's like, hey, why do we need this risk management? We have all this wonderful trust in the system. And now the trust isn't there as much. I think it's going to come back. And then there's probably going to be an even bigger loss of trust because there's probably even more stuff in the system that needs to shake out. But the point is that third dimension of counterparty risk management through digital assets doesn't really seem valuable until counterparty risk becomes more real, as it recently has. So now, when I'm saying this now versus in other previous talks that we've had, now this seems to make sense. And I think that's going to be the consistent dynamic. And I think the banks and institutions that create a digital asset capability and an ability to make and move digital assets across multiple chains and service client demand across multiple geographies and multiple formats for digital assets that their clients want will be well prepared for both market demand increase in digital assets, as well as this kind of risk management scenario, where if digital assets become viewed as a less risky form of asset container or a less risky form of asset ownership, then the institutions and the banks and all the folks that have the capacity to provide that might become very, very attractive overnight, similarly to how the internet made them very, very attractive very quickly for doing various types of transactions. And so that, that's what I think tokenization started as, and that's where I think it's going.
And now moving sort of from the traditional finance universe over to the more crypto-focused side of industry, I wanted to ask a question about proof of reserve. So following the collapse of FTX, proof of reserves gained a lot of attention. Can you talk about what that is as a concept, how it increases transparency and security for the end user?
Sure. So FTX, for me, was actually a traditional financial institution that just didn't exist for very long, and apparently wasn't well run enough to continue to exist. But it wasn't something that was really powered by cryptographic truth or blockchain technology. It was a traditional financial institution that held and dealt in crypto assets exclusively and predominantly. And so FTX's collapse, while it might seem like an indictment of the technology of blockchains and cryptographic systems, it is not an indictment of that at all. And what proof of reserves is proof of reserves is a very specific implementation of cryptographic truth and cryptographic systems that would have completely solved FTX, but it would have also solved multiple bank collapses and other collapses, basically by creating transparency. So what proof of reserves does is it basically takes the balance sheet of an institution or an entity, and it represents that balance sheet on chain. And then representing that balance sheet on chain, it proves that there's a certain level of assets and a certain configuration or mix of assets of certain types. And so the reason the whole FTX happened was, the FTX issue happened, was because there was a bank run on FTX when people found out that a large percentage of FTX's balance sheet, which was backing their deposits, was not in US dollar stablecoins or Bitcoins, but it was in FTX's own token. And so when people found that out, they decided to rapidly withdraw, which accelerated the bank run and just created more problems. What proof of reserves would have done if it was implemented from the very beginning of FTX's life is it would have cryptographically proven, it would have pulled data from FTX's backend, and it would have proven to everybody that FTX is collateralized with dollars, US dollar stablecoins, or Bitcoins, or some combination. And then if FTX decided to start changing that mix on the balance sheet and decided to start making 10% of that FTT tokens instead of the other assets, well, everyone would have found out about that in seconds. Not in days or weeks and months or years, but seconds. And then there would have been a discussion with their user base, and their user base would have said, I don't want to use you if you make your deposits backed by your own token. And then FTX would have been faced with a choice, and it would either said, okay, users, if you don't like this, I'm not going to do that. I'm going to make sure I'm backed by Ether, Bitcoin, and dollars, and so you don't need to worry. And the users would have stayed, or FTX would have made the decision, I don't really care what you think. You can leave, user. I'm going to back myself with my own token, and the users that want to stay can stay. But in both of those cases, because of the transparency of proof of reserves, you would have never had a bank run, because there would have been no surprising news to create a bank run of any kind. And so what proof of reserves really does is it uses cryptographic systems, encryption, to prove things that allow counterparties to do risk management. In the case of proof of reserves, it's really risk management about the balance sheet that an institution is using. Proof of reserves is a very exciting thing, something we launched into production over 2 years ago. It was getting some adoption before FTX, but after FTX, adoption went absolutely vertical. And there's other forms of proof of that we're working on, proof of liability, proof of solvency, proof of all kinds of other aspects of financial counterparties that also allow greater degrees of risk management. And I think that these proof of things will basically eventually differentiate counterparties such that you would go with the counterparty where you knew they were solvent second by second by second, instead of a counterparty that you had to wait for an annual audit by a person that could be gamed or could be mismanaged, like with Enron or someone else, right? And so I think this is the contribution that FTX's unfortunate failure has had to our industry, is that proof of reserve has now become the new minimum for how financial products and systems prove themselves. And it's getting applied through Chainlink to many, many different systems, including stable coins. So many stable coins and gold coins and real world asset coins are using proof of reserves to, on a block by block, second by second basis, prove that the assets that are backing the gold coin or the real world asset coin or the stable coin are actually where they're supposed to be, so that you don't have to rely on a 1 month audit or a 1 year audit. You know, second by second, that the assets backing the token that you have exist and are of a certain value and are in a certain condition in a place that's liquid. And I think that'll also be an attractive features of those tokens.
I mean, there seems to be so much potential utility and benefit to a lot of the technology that you're talking about. How do capital markets securely connect to Web3 in order to really, leverage, programmable finance, leverage technology, get the most out of it?
So I think as those three categories of adoption accelerate, whether it's cost and efficiency, servicing clients that want crypto market access, or restoring trust with existing users and the markets in general, whichever three of those, or maybe all three of those, you'll actually, as a multinational bank, be faced with the very simple problem of having to integrate with multiple chains. So beyond even creating a digital assets unit or creating digital asset products, one of your most fundamental base problems will be the fragmentation in our industry, and that multiple counterparties want to conduct transactions with you in multiple distinct environments. So there is no one environment like the internet. There are multiple distinct private chains, public chains, semi-private chains that have permissioning and identity and all those things. And so as a multinational bank, you will be looking at integrating and managing and interfacing with multiple chains. Once this really picks up every quarter you'll have to integrate multiple chains. And so the first choice that banks and financial institutions have is, how do I even conduct transactions? How do I efficiently conduct transactions in this multitude of different environments? Because the environments will vary based on geography and based on transaction type. So you might have a derivatives chain in China that's completely different from a derivatives chain in Europe, that's completely different from a derivatives chain in the US in terms of the technology that it uses. And so that's actually the problem that Chainlink solves. It's called Chainlink for a reason. And the reason is that it can connect a bank system into all of those chains through one integration. And then it can maintain those connections and it can secure those connections. And as more chains appear for banks to transact in more places, you just have a greater and greater need for this, basically. So the first challenge is, how do I integrate with chains at all? The second challenge for banks will be privacy. And this is the promise that certain private chains have made, private enterprise chains have made, but traditionally, historically, so far have not delivered on. And so the way that problem is solved with Chainlink is through zero knowledge proofs, where you can prove something to a counterparty without revealing the data to them. And so in addition to connectivity, the next stage will be privacy preservation, confidentiality. And that's something that Chainlink does through zero knowledge proofs. And then the third problem, once you integrate with the chains where you want to do basic transactions, and once you've met your privacy requirements in order to do those transactions, the next stage will be, well, wow, there's all these banks and all these competitors making decentralized financial products or programmable finance products, and they're doing well. My banking competitors are doing well. They're making these programmable finance things. They're tokenizing these traditional assets, and there's demand. So the next challenge will be, how do I, as a bank, build those things? How do I make my own tokenized assets? How do I make my own programmable financial products? How do I accelerate my ability to compete in that market? And in that sense, you would need to choose an environment into which your assets would be issued, which you'd also want all the other banks to be able to easily connect to, which Chainlink can also help with. And then you'd need a bunch of tools, such as validated market data, automation, functions, and a whole bunch of other things to build those. Because if you actually look at DeFi, DeFi is a combination of on-chain state and Oracle networks. On-chain state is what blockchains make. Chainlink makes Oracle networks. And so that's the third hurdle. But you only really reach that hurdle as a bank when you've decided you want to really compete and make programmable financial products. You don't want to just be a transactional counterparty because you want to participate in them. So the first two are about participating, and the final one is about creating the programmable finance products yourself.
Mm. And what will the next stage of adoption be for smart contracts in the global economy? You know, where are we? What's coming next? And how does Chainlink kind of fit into the vision?
A lot of that is actually quite hard to predict because it depends on certain macro dynamics that are hard to predict, basically. So I would say that the crypto markets, the public blockchain crypto markets, DeFi and various tokens, once they passed $200 billion, I was absolutely sure that this was a market that will not go away. Now they've passed over $1 trillion, which is an extremely large market, even for the banking industry to take part in. Ergo, why the clients come to them and say, can you custody stuff for me from the public blockchain world? Because it's a big enough market. So the market is already there. It's going to grow gradually no matter what, because the value of it makes sense. And there's a gradual, compounded annual growth rate for the crypto market that I think has a very high floor. I don't know what it is, but it's probably something like 20 to 50% a year in terms of the amount of people involved, maybe not in terms of the total value in the system, but in terms of the amount of users, the amount of applications, the amount of everyone doing things. I think that the thing that really decides the rate of adoption is that crisis of faith that I mentioned. And that crisis of faith exists on a spectrum, right? One end of the spectrum is people who are already very paranoid and already really committed, and they hold all their wealth in gold and crypto assets, and they're like, the world's coming to an end and that's it. And so the question there is, how much more are they going to buy? And how much more are they going to participate in the economy, the crypto economy? Then you have people that are kind of in the middle, who don't know if crypto is a scam or not a scam, don't understand its value yet. But I can definitely tell you that on the retail level, retail bank failures, in my mind, really, really make the case for crypto very, very strongly. Because your alternatives after you've seen a retail banking failure is basically two things. It's buy physical commodities, or it's get crypto. And realistically, in line with the diversification thesis, I think it's going to be some percentage in each. What that percentage is going to vary for people in that middle. And then there are people on all the way on the other end of the spectrum that are completely convinced that traditional financial systems can do no wrong and their trust assumptions are completely solid. I think some of the recent institutional issues are going to make those folks wonder. And I think what they're going to get is they're going to get digital asset formatted value. So they're not going to necessarily want to speculate on Bitcoin or some other asset, right? Just like they don't want to become a gold bug and go buy 20% of their portfolio in gold for the same reasoning, right? They view it as speculative and it doesn't sit with their thesis. I think though, when you come to them and you say, here's an asset you're used to, but it's formatted in this digital asset container that has less counterparty risk. I mean, these are pretty smart people in my experience, and they're going to say, wow, okay, I've been having counterparty risk problems. I've been having real concerns about my counterparties. Talk to me about how your digital asset has less counterparty risk than my traditional financial system asset. Can I move it faster? Do I have more control over it? How is my counterparty risk reduced? And I think when they look at that in more detail, they're going to see something very attractive from a risk management point of view. which, like I said earlier in the conversation, risk management doesn't get a lot of attention when everything's going well and everybody's printing money, literally, right? Literally printing money. But when as people put it in the financial industry, when the tide goes out, that's when risk management really starts to be quite important. And so I think that digital assets have a large role to play here. In all three of those categories, the people who are convinced that the traditional financial system, you can't meet their needs, the people in the middle who kind of don't know what crypto is and might consider it as a certain percentage of their portfolio to hedge risk, and even the institutional people that are convinced that the trust assumptions of the financial system will always work. I think all three of those groups will get accelerated by their own unique crisis of faith, basically. And I think that the global economy, due to a number of factors, both politically driven factors and various other factors that I'm not going to really go into here, has been driven into a state where a hard landing, in my opinion, is very, very likely. And that hard landing is synonymous with the crisis of faith that I keep discussing in this conversation. And I think the thing that someone should ask themselves is that believes in a hard landing. I think they should ask themselves, what technologies are going to help you get out of a hard landing? That's basically what I'm saying in a very succinct form. Like if there's a very hard landing in the global economy and there's serious crisis of faith for all three of those groups, what technology restores faith in financial systems, financial products, financial relationships? And I don't mean that it replaces banks and institutions. There's just like the internet posed companies with a choice. Do I participate in the internet or ignore the internet? The companies that participated in the internet did great. So I think a lot of existing systems and banks and brands can completely continue and even succeed to a greater degree than they are today, if they're able to adapt to this new reality. But the fundamental question really is, do you believe that there will be some kind of serious hard landing? And if so, will there be a crisis of faith? Which I think is obvious. Those two things go together. And then the question is, how will faith in the system be restored? And my very strong view, once again, is that encryption technologies like blockchains and smart contracts and Oracle networks, those are the things that are going to be used wholesale to restore faith in financial relationships and systems and counterparties in general.
Sergey, unfortunately, we're out of time. Always insightful talking to you. Thank you so much for speaking with us today. And looking forward to another one of these, hopefully next year when the markets may calm and you might see some of these tailwinds that you've been describing kind of kick in. Thank you so much for being here.
Great. Thank you for having me.